Are you looking to make your money work for you? Today, we're diving into how you can start earning passive income through dividend investing, even if you're starting with just $10,000. The idea is to break down $10,000 in four equal portions and allocate it to each of the four stocks or mutual funds we discuss ahead. Let's start with the first one. Agree Reality. That's ADC on the New York Stock Exchange. Agree Reality specializes in acquiring and developing properties leased to retailers that are less susceptible to economic downturns, such as grocery stores, home improvement outlets, and convenience stores. With an investment in Agree Reality, you're looking at properties that have a high occupancy rate and stable tenants. This contributes to the company's ability to pay consistent dividends. As of now, $2,500 invested in Agree Reality could yield an annual income of $111.50, amounting to $9.29 monthly, based on its current dividend yield of 4.46%. To invest in Agree Reality, you can use any major brokerage platform that provides access to the New York Stock Exchange, where ADC is listed. Platforms like Charles Schwab, Fidelity, or even app-based brokers like Robinhood offer an easy route to purchase these shares. For international investors, brokers that provide access to U.S. stocks like Interactive Brokers can be used. Don't forget to consider the brokerage fees and the currency exchange rate if you are an international investor. Investing in Agree Reality, as with any stock, comes with its share of risks and challenges. Key risks include market volatility. The real estate market can be subject to fluctuations due to economic cycles, interest rate changes, and other macroeconomic factors. Tenant dependency. While Agree Reality boasts a diversified portfolio, any financial troubles faced by major tenants could impact rental income. Interest rate sensitivity. As a REIT, Agree Reality can be sensitive to interest rate changes. Rising rates could increase borrowing costs and affect profitability. Regulatory changes. Changes in real estate and tax regulations could impact Agree Reality's operational costs and revenue streams. Despite these risks, Agree Reality's focus on essential service retailers and its conservative payout ratio make it an attractive option for investors seeking steady monthly dividends. However, it's crucial to align this investment with your overall portfolio strategy and risk tolerance. So moving on to the next one. We have EPR Properties on our list. EPR is a unique player in the real estate investment trusts or REITs market. Listed under NYSE as EPR, this company offers a distinctive investment opportunity. Let's explore why EPR Properties stands out and what potential investors should know before buying. EPR Properties specializes in experiential real estate, an intriguing niche that includes assets like movie theaters, family entertainment centers, and other attraction-based properties. This focus on entertainment and leisure distinguishes EPR from traditional commercial or residential REITs. With a substantial investment of $2,500 in EPR Properties, you could earn an appealing $181.75 annually, breaking down to $15.15 monthly in dividends. This higher-than-average yield is a significant draw for investors looking for consistent income. EPR Properties boasts a robust financial profile with considerable liquidity and an income surplus. These factors contribute to the sustainability of its dividends, making it a potentially reliable income source for investors. Where to purchase EPR Properties stocks? You can buy EPR Properties stocks through most brokerage firms that provide access to U.S. stock exchanges. For investors preferring small investments, many brokers offer fractional shares. International investors should ensure their brokerage supports U.S. market access and be mindful of currency exchange rates. Risks and challenges. However, investing in EPR Properties is not without its challenges. The company's focus on experiential real estate can be both a strength and a risk. Sectors like movie theaters have faced significant disruptions, particularly during events like the COVID-19 pandemic. Moreover, changing consumer habits and digital shifts pose ongoing challenges. Potential investors should consider these market dynamics and how they might impact EPR's future performance. Third on the list is Stag Industrial. Stag stands out with its focus on industrial real estate. This includes warehouses and distribution centers, which are crucial in today's e-commerce-driven economy. Their portfolio is designed to support the backbone of supply chains, making it a contemporary and relevant investment. For those considering an investment, putting $2,500 into Stag Industrial could yield an annual return of $103.75 in dividends, which translates to about $8.65 monthly. This consistent dividend payout is a significant attraction for investors looking for regular income streams. One of Stag Industrial's strengths is its strong investment-grade balance sheet. This financial robustness is reassuring for investors, as it suggests a reliable dividend payout and potential for long-term growth. Where to purchase Stag Industrial stocks? You can purchase its stock through most brokerage firms that offer access to the U.S. stock market, such as Fidelity and Vanguard. Many of these platforms also offer the option to buy fractional shares, making it more accessible for those looking to invest small amounts. Risks and challenges. While investing in Stag Industrial might seem appealing, it's crucial to consider potential risks and challenges. The industrial real estate market can be sensitive to economic cycles, with demand fluctuations based on economic conditions. Additionally, the rise of remote work and digital transformation could impact the demand for physical storage and distribution spaces. Investors should also be mindful of the company's exposure to any specific industry sectors or geographic regions, as these could affect its resilience in face of market changes. And the final one on the list is Realty Income. Realty has garnered attention for its diversified portfolio, which spans retail, industrial, and entertainment sectors. The diversification is a significant strength, as it reduces reliance on any single market segment, potentially offering more stability and resilience against market fluctuations. For those considering an investment, allocating $2,500 in Realty Income could yield an annual dividend of $127.50, equating to $10.63 monthly. This REIT is known for its consistent dividend payouts, which is a major draw for income-focused investors. Financial strength. One of Realty Income's key attributes is its strong balance sheet, coupled with a low dividend payout ratio. These factors suggest a healthy financial state, which is crucial for the sustainability of dividend payments and long-term growth potential. Where to purchase Realty Income stocks? Realty Income stocks can be acquired through most brokerage firms that provide access to the U.S. stock exchanges, such as Interactive Brokers or Robinhood. Risks and challenges. However, investing in Realty Income isn't without its risks. The retail sector, a significant part of its portfolio, can be vulnerable to economic downturns and shifts in consumer behavior, like the increasing trend towards online shopping. Additionally, the broad spectrum of its portfolio means exposure to various market dynamics, requiring investors to understand these sectors' potential impacts. It's also essential to keep an eye on interest rate changes, as they can affect REIT valuations. The approach we discussed of diversifying $10,000 across these stocks or REITs yields a return of $44 every month and sums up to $525 annually in passive income. This might not feel like a lot of money, but over a longer run, this can definitely start generating substantial returns as your investment increases. Like, for example, investing $100,000 instead of $10,000 could yield you a dividend income of $5,250 annually. And let's not forget the capital appreciation that the stock or mutual fund receives, as that would be an added bonus. Remember, the goal of this guide is to help you start making passive income through smart, informed decisions in the stock market. With an initial investment of $10,000 spread across these high-yield stocks or mutual funds, you can begin to build a portfolio that not only offers regular income, but also has the potential for growth. If you found this video helpful, don't forget to like, share, and subscribe for more insights into making your money work for you. Join us next time as we continue to explore more strategies and opportunities in the world of investing. Your journey towards financial freedom starts here, and we're here to guide you every step of the way.